The best thing that can happen is to have markets that go down a tremendous amount. I mean, we are going to be buyers of things over time. If you're going to be buyers of groceries over time, you like grocery prices to go down. If you're going to be buying cars over time, you like car prices to go down. We buy businesses. We buy pieces of businesses, stocks. And we're going to be much better off if we can buy those things at an attractive price than if we can't. So we don't have any fear at all. What we fear is an irrational bull market that's sustained for some long period of time. You as shareholders of Berkshire, unless you own your shares on borrowed money or are going to sell them in a very short period of time, are better off if stocks get cheaper, because it means that we can be doing more intelligent things on your behalf than would be the case otherwise. And we wouldn't care what anybody thought about it, most of all ourselves. We very seldom find something to buy on a negotiated basis for an entire business. We have certain size requirements, big limiting factors. It has to be something we can understand. I mean, that eliminates 95% of the businesses, and we don't pay any attention to them. We get lots of proposals for things that totally outside the boundaries of what we've already said we're interested in. We prefer to buy entire businesses or 80% or greater interest in businesses, partly for the tax reasons you mentioned, and frankly, we like it better. It's the kind of business we would like to build if we had our absolute druthers on it. Counter to that is we can usually get more for our money in wonderful businesses in terms of buying little pieces of them in the market, because the market is far more inefficient in pricing businesses than is the negotiated market. You're not going to buy any bargains, and you shouldn't even approach the idea of buying a bargain in a negotiated purchase. You want to buy it from people who are going to run it for you. They want to buy it from people who are intelligent enough to price their business properly, and they are. I mean, that's the way things are. The market does not do that. In the stock market, you get a chance to buy businesses at foolish prices, and that is why we end up with a lot of money in marketable securities. If we absolutely had our choice, we would own 3 times the number of businesses we own outright. We're unlikely to get that opportunity over time, but periodically we'll get the chance to find something that fits our tests, and in between we will, when the market offers us the right prices, we will buy more, either businesses we already own pieces of, or we'll buy 1 or 2 new ones. Something's usually going on. There are tax advantages to owning all of them, but that's more than offset by the fact that you'll never get a chance to buy the whole Coca-Cola company or the whole Gillette company. Businesses like that, the sensational businesses, are just not available. Sometimes you get a chance to make a sensible purchase in the market of such businesses. We define risk as the possibility of harm or injury, and in that respect, we think it's inextricably wound up in your time horizon for holding an asset. If your risk is that if you intend to buy XYZ Corporation at 11:30 this morning and sell it out before the close today, in our view, that is a very risky transaction, because we think 50% of the time you're going to suffer some harm or injury. If you have a time horizon on a business, we think that the risk of buying something like Coca-Cola at the price we bought it at a few years ago is so close to nil in terms of our prospective holding period. But if you ask me the risk of buying Coca-Cola this morning and you're going to sell it tomorrow morning, I say that's a very risky transaction. Now, as I pointed out in the annual report, it became very fashionable in the academic world, and then that spilled over into the financial markets, to define risk in terms of volatility, of which beta became a measure. But that is no measure of risk to us. The risk in terms of our supercat business is not that we lose money in any given year. We know we're going to lose money in some given day, that is for certain, and we're extremely likely to lose money in a given year. Our time horizon of writing that business would be at least a decade, and we think the probability of losing money over a decade is low. So we feel that in terms of our horizon of investment, that is not a risky business, and it's a whole lot less risky than writing something that's much more predictable. Interesting thing is that using conventional measures of risk, something whose return varies from year to year between plus 20% and plus 80% is riskier as defined than something whose return is 5% a year every year. We just think the financial world has gone haywire in terms of measures of risk. We are perfectly willing to lose money on a given transaction, arbitrage being an example. Any given insurance policy being another example. We are perfectly willing to lose money on any given transaction. We are not willing to enter into transactions in which we think the probability of doing a number of mutually independent events but of a similar type has an expectancy of loss. We hope that we are entering into our transactions where our calculations of those probabilities have validity. And to do so, we try to narrow it down. There are a whole bunch of things we just won't do because we don't think we can write the equation on them. But we basically, Charlie and I, by nature, are pretty risk averse, but we are very willing to enter into transactions. If we knew it was an honest coin and someone wanted to give us 7 to 5 or something of the sort on one flip, how much of Berkshire's net worth would we put on that flip? Well, we wouldn't. It would sound like a big number to you. It would not be a huge percentage of the net worth, but it would be a significant number. We will do things when probabilities favor us. The value of every business, the value of a farm, the value of an apartment house, the value of any economic asset is 100% sensitive to interest rates, because all you are doing in investing is transferring some money to somebody now in exchange for what you expect a stream of money to come in over a period of time. And the higher interest rates are, the lower present value is going to be. So every business by its nature, whether it's Coca-Cola or Gillette or Wells Fargo, is in its intrinsic valuation is 100% sensitive to interest rates.